Imagine unlocking the secrets to not just surviving, but thriving in the property market. Transforming your financial future with strategies that most investors overlook. Welcome to the Get Rich Show, where today we're not just talking about property investment, we are diving deep into the game-changing tactics that could redefine your approach to building wealth. Hi, I'm Rusty, your guide on this journey, leveraging my expertise as a property wealth strategist and the founder of Get Rich Properties to bring you insights that could be the difference between a portfolio that flounders and one that flourishes. Today, we are thrilled to have Manpreet from Aussie, a titan in the realm of property techs in Sydney, serving clients Australia-wide and beyond. With a wealth of experience, Manpreet is here to shed light on the critical yet often misunderstood aspects of property investment. From the pivotal role of tech structures to the nuanced decisions about property ownership and financing. We are covering the terrain that could make or break your investment success. Welcome, Manpreet. Thank you so much for joining us.
Thank you, Rusty. Thanks for having me. Hello, everyone who is listening to this podcast. This is Manpreet from Aussie. I'm an accountant by profession and a property enthusiast because of my personal preferences in terms of my investment strategy and my journey of being an accountant working with the property aspect. So I'll be happy to share my journey with you guys, why I'm an accountant, how I became an accountant, and why I love property.
Oh, we would love that. We would love to hear, Manpreet. Like it's just always, it's not just about the knowledge, it's also about you and where you're coming from so that we can have a lot more, I guess, reasons for us to listen to you. So maybe if you can deep dive in your own journey, like what brings you here, what you do, and why we should listen to you.
Okay, well, why you should listen to me? My voice may not be that great, but I may bring you some knowledge. That would be the reason why you may listen to me. Now, I came as an immigrant in 2006. I studied accounting, and I had my own challenges in terms of I had a vision of building wealth. Now, when I look at people building wealth, there's so many ways people want to build a wealth, but my personal preferences were always around the property space or real estate space where I could build my personal wealth. The idea of property comes with a lot of nuances in terms of taxation, capital gains, a lot of relatable items like servicing. So my interest, because I come from a bit of an accounting background, I decided I'm going to continue my journey as an accountant while specializing in property tax matters. And over my journey in accounting, working for a lot of accounting firms, I decided I'm going to create my own small firm. That's how I started my business, and I started focusing on clients who are interested in their property journey while I was building my own property portfolio. So that's my journey in terms of being an accountant, why I love being in accounting, because I can understand the numbers in much more depth and at the same time work on my property portfolio and help the clients who are looking to create their portfolio. So my specialization works around property taxes, GST, negative gearing, positive gearing, why you should invest in property, why you should not invest in property, or any other property tax related matters and nuances that you may have in a day-to-day life.
Sure, Matt. Look, as you know, I'm into property as well. It's all about numbers. It's about knowing your numbers as a basic thing. For some, that's very boring stuff. Who wants to talk about numbers? So before we jump in the importance of the numbers, tell me about you as a person, about your family, about your likes, dislikes, Manpreet, if you don't mind.
Okay, so I have my partner. We are a small family. I don't have kids yet, but we have a dog, which we call our child. He's 8 months old. That's my family. I like to spend.
Sorry, I missed that. Who is 8 months old? Did you say? You got
my dog. His name is Xylo. He's a little poodle that we have. In terms of my personal life, I like playing sports. I play tennis on the weekends, or if I'm not playing, I'll usually spend time with my better half and take her out for a brunch on the weekend. That's what we enjoy most. and we talk about strategies. She's very interested in, she doesn't come from accounting or property background, but she's always interested in talking strategies of wealth building, and she's always interested in discussing these matters with me. So yeah, that's what we enjoy in our personal life.
That's
And
good.
my other child is my business, which I raised from last 12 years. Yeah, so that's my partner says that's your first wife, by the way. So that's where I spend most of my time. So
Nah, look, I totally understand. Running a business myself, it's like the heart that goes out, and with the intent of adding more value to the people that you're working with. So I'm hearing three different, I guess, aspects or maybe two aspects of property, wealth, and strategy. Let's talk about what's wealth. What is your definition of wealth? I know you're an accountant, but in your personal wisdom, what's the definition of wealth?
look, my personal take on wealth is yes, for most people, we do want to look at our net asset value, for example, or how many assets do I have. People compare that as a number when it comes to wealth. For me personally, wealth is your overall lifestyle. It could be your work, it could be your business, it could be your leisure time. If you are happy in all aspects of your life, while creating something for your future, which I call a safety net. Because with COVID, one thing we've learned, you don't know how times will change in your favor or against you. For me, building a portfolio on the side, whether it's a property or for personal preference, someone may have other options, but my personal preference being property, while working hard in your job or business, which we do, me and my partner, we like to keep building our wealth portfolio, which is in form of property. Now, I don't intend to have 100 properties, or I intend to have enough that would feed my living at some stage if I want to retire. And your wealth needs to match your lifestyle. So if your lifestyle is that I need to spend $2,000 a week, your wealth should generate $2,000 a week someday. So once you are free from your job or business, you should be able to enjoy that. That's wealth for me.
That's so much that I can resonate to that answer, because wealth is not about money. In your words, as you said, it's about your lifestyle, and it's more holistic, because it's not so much about money or the net asset value that you mentioned, because it's only your safety net. But more important than that is like I guess I would add your lifestyle, your health, your well-being, your spiritual well-being, your emotional, as when you have the family around you. But of course, wealth is important, as money is important, but that's not everything.
Yes.
I also
that's why what you mentioned, property, strategy, and wealth. So it's important to have that property, which will become part of your wealth. But if you don't have a right strategy for your lifestyle, those things are very much disconnected from each other.
Sure. Let's dwell into this. What do you mean by strategy? I mean, what is strategy?
So the ultimate goal is wealth, right? As we discussed, because that is our lifestyle we want to achieve. Property is a pathway. But how you connect your wealth and property together, that's where the strategy is.
Okay.
Strategy is how you're going to have just the carrots that you have in your fridge presented in a fine dine format in your plate. That fine dine plate is your wealth. Carrots are your property. But how are you going to cook it? That's your strategy.
Okay. So look, it's very close to the analogy that I use, and I'll probably bring some similarities around it. I always say the strategy is more of a GPS, your roadmap to get there, from where you are, what your current numbers is, and where you want to go. And then we really need to be mindful of the resources on the way.
Yes.
In your example, as a culinary example, you mentioned that if you really want to have a fine dining experience, because in your definition, what I'm really liking is the experience as well. Yeah. You can have, the carrot as is, or you can really make it more of an experience with the lighting and wine and whatnot. But how do you go about preparing it? And the key question is being resourceful. Having that fridge, having that carrot in the fridge now really makes you more of planning mindset that, okay, how do I really want it? So the key thing which I found, again, this is from my experience of talking to so many people, sometimes it's limited by the vision that they have on their wealth. Like it's sometimes so myopic or sometimes so short-sighted. They're always looking only for the next thing rather than looking at the long term and working it backward. So what's your take, Manpreet? Because I know as a successful accounting business, when you talk to the people on a daily basis, and not just business, people, but also the businesses, I'm pretty sure it's very much common as a concept, looking at the long term coming back. So maybe your 2 cents around it, Manpreet?
Look, you are correct. We meet people, we meet a lot of different clients. Now, it all comes down to the risk appetite, one thing. Of course, the resources, as we mentioned, how many carrots you got in the fridge. And then, of course, your risk appetite of having that, your resources, and the other important thing is your recipe to success. How are you planning to go where you want to go? Right? Now, I would have dealt with number of clients where their intention is, oh, okay, I want to just pay off my owner-occupied property. That's my intention because I don't want to have a mortgage. But then you're not going to sell your owner-occupied mortgage house, or even if you end up paying your mortgage, you're not wealthy because you're not going to sell the house if you were to retire to put a food on your plate, right? And then on the other hand, we have clients where we deal with the strategies, we work with them closely to understand what they want to achieve. Some people, I meet people, they want to build a portfolio of 6 properties in 6 years. Now, in most cases, it is achievable. That's where the recipe to success comes in. We need to reverse engineer. If I have a client who wants to have 6 properties in 6 years, we look at the end goal first. We'll look at their resources in the fridge, which should be their income, their assets, their equity, and we'll see how we can get you there. And is it even achievable goal in 6 years' time?
Just for the starters who are really thinking about properties as a way of building wealth, because we talked about property, in your words, is the pathway, it's the recipe. It's more of a means to get to the goal, but not really the end goal by itself as a property. So of course, property is a growth asset, but why would you prefer property over any other asset class, Manpreet, in your terms?
Okay, look, the way I look at property is because we are blessed to be in this country like Australia, where there has been, and you're probably the property expert, you can validate to this, we have had consistent growth over the period of time. Property is not like shares that you buy today and sell tomorrow. And even if you invest in shares, over the long term, you would gain that momentum and value. But property actually had a proven track record that over a period of time, you can have a consistent average growth. Now, why I personally prefer property is because of leverage. Now, if I have $100,000 and if I'm trying to get 6% return on my $100,000, that's $6,000 a year. But with the property, I can go and buy a property worth $500,000 where I pay 20%, which is my $100,000. Now I've leveraged that extra $400,000 from the bank. Now imagine if that whole $500,000 are growing at 6%, you're leveraging on bank's money. That's where you're building your wealth.
Sure.
Your rents, if you got a reasonable rent on a property, it's likely to cover your mortgage. But any growth on that $500,000, it's adding to your virtual capital, which you will realize one day when you're going to offload that asset or even take the equity out and keep building your portfolio. So for me, over the period of last 7 years, this is how I've built the portfolio. Yes, you may not be always able to extract equity depending on how the market performs, but this is how you can continue to build small amount of wealth year after year. You've got 20 years to retire. There is a likely chance if you follow a right strategy, you might be able to build $2 to $3 million worth of portfolio. And I'm talking about couples, full-time working couples with a reasonable income. And there are strategies out there to do that.
Like just a very quick stats around it, Manpreet. I totally agree with you what you just said, that the property investing has to be considered for the long term. because as you said, like when we have more time horizon, then it's more likely to go in your favor. Just as an average, again, I will also make a point that not all the properties, not all the regions, not all the price points makes it a good investment. And that's what probably we'll jump into it very quickly. But there's more other important aspect for us to learn from you as an accountant. I'll hold that thought for now, but very quickly, just on the statistics, the national housing median in Australia in 1980 was $77,000. $77,000 for today. If I look at that number as of 2023, ABS data, that same Australian housing median is sitting at $770,000. So X in 43 years. So I jokingly, I used to ask that, okay, if you knew this fact, the benefit of hindsight, how many properties would you buy in 1980? Oh, I was not born, of course. If you were there or you had an influence on your grandparents, how many properties would you buy in that year? The typical answer I get is as many as possible.
You give me a time machine, I'll go back and buy at least 10.
There you go, at least 10, right? Why not 100? I mean, somebody says the whole Australia.
Yeah.
Now, the key question is it really, first of all, like what sort of rate of growth? I put in my calculator, the computation around it. The capital growth rate is 5.6% to get that result.
Yeah.
And 5.6 is pretty average. I mean, that is very consistent number. It's not that exceptional 43 years I'm talking about. And if we choose to extrapolate from now, the median should be touching around $7 million.
Yeah.
Right?
That is going to happen.
So no point, no argument about going back in the time. The time is now, because as we say, the last time to plant the tree was 20 years ago, and now the best time is now after that. So look, but the key question is that are the fundamentals strong to keep having that? Of course, we all know it's about the supply and demand, the population that we have in this place. But look, I'll leave that discussion for now, but because I'd really like to get into your the skills or the expertise around the structuring as an accountant. So yes, we should be buying more properties. Yes, people really want to, in your example, want to buy 6 properties in 6 years. The sorry truth is, again, maybe some statistics around it, 90% of property investors have only 1 or 2 investment properties.
Yes.
But then it's only less than 1% of the property investors who are able to go beyond 5 or 6 properties in their tenure of buying properties. Of course, there's something which is stopping an average investor to build that up. And part of me feels that it's because the structuring or the lack of vision. Maybe in your perspective, what you see?
The situation for each individual or a family is very different. More than the situation, it's about what they believe they want to achieve. So if you believe higher, you'll achieve higher. That's what I believe. Higher.
So it reminds me of abundance out there. The money abundance as a belief, and then bringing to your own target. So no, go on. I'm liking this.
And the reason, and because you are a property expert and you can probably validate my point, a lot of people don't end up buying multiple properties because they are stuck in a cycle of saving a deposit to buy a property that they believe is best property. I'll give you an example. I was speaking to a client, they wanted to buy their second investment property, but in their head, they're thinking, oh, this is the only area I want to buy in. Now, in that area, an average property was $1.5 million, which means if you're saving 20% deposit plus stamp duty for that, yes, you may be able to extract some equity. But if you're trying to achieve that, you're never going to achieve that because you're trying to save a big chunk of money. And by the time you save that, the property price is also moving ahead. We broke down the strategy for them. Why are you thinking to buy a $1.5 million property? Why can't you buy 3 properties of $500,000, which first are likely going to give you better rental returns? You have diversified your property portfolio in terms of dynamics, demographic, even the kind of property. You could split into residential, commercial, or whatever your property expert suggests.
Sure.
That way, you're riding the equity growth on each of them. And it's easier for you to come up with a $100,000 deposit, buy first one, at least let that property grow, and then jump onto the second one, jump onto the third one. This is the biggest issue I see, a lot of people are not able to decide because they cannot come up with a deposit. And again, tax structuring and all that. Sometimes you have to, the wealth is all about reaching an ultimate goal. Yes, you may have a couple of good assets. Sometimes you have to also let go of an asset to build a better portfolio.
Sure.
I had a client who had a property in Cherrybrook. They bought it for $2 million. The rental return on that property is $1,000 a week.
Yeah, pretty much, yeah.
Yes, they were a happy couple because the interest rates were sitting at 2.5 on a fixed term for 2 years for them. But now they've fallen to 6.5 because it's an investment property. It was breaking even at some stage, but now they have to put a lot of money back into the property, which they could have saved to jump onto their second asset.
Yes.
Or third asset. Now, people are always worried about, oh, if I sell my property or if I get rid of a bad asset, I have to pay a lot of tax. Not necessarily. There are a lot of strategies around saving capital gain tax in a very legitimate ways.
Wonderful. So what I'm hearing from you is that when we have the clarity of the end goal, which is the number of your wealth numbers as in accounting numbers, it doesn't matter whether you achieve this by 1 property or 3 properties or 5 properties, as long as you have, I guess, decent lifestyle on the journey as well, because it's not always about the end goal. It's about the journey on the way, that it has to be enjoyable. People should be able to sleep well in the night. They are taking this more as a business of for themselves as well. Property investing is not a hobby. It's not a side hustle. It's more about a business by itself, whereby the importance of picking the right team, the right strategy are paramount. Or really like that. And now, when we talk of the structure, I mean, from the accounting point of view, like we get a lot of people, a lot of clients who come and say that they have the broker working on the pre-approval, and pretty much it's always tend to be, not always, I mean, most of the time it tends to be in the joint names as the loan pre-approval. And then the question is like, should they really buy in the joint names? What structure? Should there be either or so there are a few components there. So maybe we'll start with that. Like when they're going the joint name, what type of tick box should they pick in the contract?
Okay, which structure should I buy a property in? That's a very common question, and there are a lot of myths around. I should buy in trust or I should buy in this, because of course a lot of people just overhear people talking it about.
Sorry, Manpreet. We'll get into that very quickly. But where I'm coming from is the couple has already made their mind that they are going to buy in the joint names because the loan was approved in there. So now, of course, they can really go for a split percentages.
Yeah.
Which again, we can talk about it, like how to think about it. But it's more around, like where it's more of either survivor, should it be common in tenants? So, there are some options out there. Do you have?
Yes. From tax perspective, yes, a lot of people end up buying in joint names, usually husband and wife. It does restrict you in a longer term, because if you look at the banking system, you may have more flexible opportunities to buy multiple assets if you kept the investments on either or name.
Okay.
So the whole idea behind going 50-50 is because you might better half. That's what we call it. So we're gonna give you everything half. It's more like a safety decision that husband and wife or couples, they just want to go half and half. But you need to understand, if you're going 50% in the property, and usually one partner is earning probably higher income than the other. So if that property is negatively geared and you both are in a different tax bracket, the negative gearing is going to impact in terms of who's going to claim more tax benefit out of that. But on the hindsight, if that property grows substantially in value, the capital gain tax will also be higher for the partner who owns 50% and who is earning a higher income. So in terms of taxation, it is very crucial to understand how you want to structure that. I have clients, I have a client, he's got 3 investment property, it's 99-1. 1% is because bank wants to have the partner's guarantee on a loan for servicing perspective, and the other partner owns 99% of the asset on the books, which is on the title, because he wants to claim a higher negative gearing, because the partner earning lower income, which is 1%, is only earning about $40,000 income, the other partner is earning 240,000, the tax differential is higher. One partner is probably paying 19% average tax, the other partner is paying 47% tax. So on a negative gearing from 3 properties, because there's a depreciation on the properties sometimes, you'll have a higher tax benefits.
Sure. Now this is awesome, and I really understand the logic between going from 50-50 to 99 or 1, as in this example. But sometimes the need is more psychological, that your partner is involved in the title, they feel the ownership. But from the accounting point of view, that 99-1 is pretty much as good as 100-0. And then there's a land tax implication comes into play, because yes, as a partner, somebody holds only 1%, but in a way, from the land tax computation, that land still gets added to the same 100% for that person.
That's right. So land tax plays another big role. The important thing to understand in property taxes is you got 2 taxes. You got your federal taxes, which you pay to the ATO, which could be your capital gains tax, or anything to do with property income or property negative gearing. Then you got your state taxes. It depends on which state you are based in. For example, in state you pay land tax, and of course you pay your other rates to the states. Land tax plays a very important role in a lot of people's life when it comes to jump on a property journey and adding multiple assets. And that's when people start looking at, oh, okay, I've got 2 properties. I want to jump on the 3rd one, but I think I'm going to have to pay land tax. So it sort of holds their decision. And that's where the structuring comes in very handy. How to strategize your property purchase over a period of time so you can minimize your land tax. Of course, you have to speak to a land tax expert when it comes to that, because it's a very complex tax system. But it's important to understand there are legitimate ways to strategize to reduce your tax liability when it comes to adding more property, just by giving a right structure.
So when you say structure, are you referring to going through, say, trust structure, going to super, going in individual names, maybe being mindful that, as you mentioned, that's a state law, then maybe it makes much more sense to even diversify outside the state, because then what I hold in Queensland has nothing to do with my land tax calculation. I mean, unless they change the rule. There's always a rule around it, I mean, there's always a risk when it comes to the policies. There's always a legalistic risk.
And you're exactly right. And that's what people are doing who are actually expanding their property portfolio to 3rd, 4th, 5th, 6th property. They're diversifying that into different states. Because at this stage, the value of each property in a different state does not consolidate back to you for the land tax purposes, because they are state taxes. But if, again, as you said, if the rule changes, that would be a different scenario. And then looking at other structures. Now, trust structures do come in handy when you're already paying land tax, because trust structures do not get a land tax exemption, like a family trust structure will not get a land tax exemption. Now, if you have kids involved who you want to be part of your property portfolio, kids have grown old enough, it sometimes comes in handy to have that structure in place. If you've already exhausted your land tax threshold and you're probably going to pay the land tax anyways in that particular state, trust will come in very handy, because you can do an asset protection strategy. Of course, you have to have a legal advice on that. When it comes to that, you can attach asset protection strategy. You can involve your kids as part of the beneficiary structure in the trust, and then you're not paying any extra tax. You might be actually benefited from this whole structure. And the other option is, depending on what property you're buying, you can consider buying it through SMSF. Of course, there's a whole financial advice aspect to buying properties in SMSF, or setting up an SMSF or not setting up an SMSF, but that really depends on a lot of personal situation of clients. Personally, I have an SMSF. I have 2 SMSFs, and I've got 2 separate properties with 2 separate group of people in each SMSF. Wonderful. So that comes in as a handy strategy as well.
Beautiful. And I really like the idea of bringing the family members in the family trust. Not only the capital preservation comes into play, but then there's estate planning that can happen eventually without really getting into the nitty-gritty of the sales tax, or not really sales tax, capital gain tax, or the state will tax and whatnot. So it sounds like there's so many things out there, Manpreet, and for someone who's starting afresh, seems that there's dilemmas around it, so many dilemmas. But at the same time, there are people on the sidelines that really want to learn everything first before they do anything. That's one category. Second category is that, look, it's too much for me. I can't take it anymore. And I probably won't talk about the third category, which is like, okay, I'll do whatever it is, and then I'll see what happens later on. Yeah. Of course, I'm not really keen on the third one because, of course, there are action takers, but that could be a costly mistake and taking the shortcut around it. Of course, we don't like the second category as well, which are sitting on the sidelines for too long, which we commonly call as analysis paralysis. So talking about the first one, when there's so much dilemma, how do they go about navigating this when there's so many unknowns out there, so many things to be worked out, so many terminology? I'm talking to an accountant right now. When they go to a broker, they talk about different things. How do you pull it together for a new startup?
Okay, so you use the right terminology. How do we pull it together? When we're pulling it together, I think it's important to emphasize the importance of having the right team. So yes, a client may have an accountant, a client may have a broker, a property expert, a financial advisor. But if your team is not closely working together, one, and if your team is not expert in your strategies that you want to follow, not every accountant would be specialized in SMSF, not every accountant would be specialized in property. I may be not specialized in some other things. And same with the brokers, same with financial planners. You need to work with a very close-knit team where you can sit together, probably have a Zoom call with all your 4 advisors, which is your property financial planner, finance broker, and accountant. So they can understand where you want to go. And then 4 of the strategists can perhaps build a right strategy and a pathway for you. So it's about pulling it together. Because at the end of the day, and one accountant would be a competitor of another accountant, for example, or any business for that matter. I like to work with other accounting firms or other accountants when it comes to advising on certain things that they're not good at, or vice versa. We like to work closely with brokers. We like to work closely with people like yourself because you are the experts in the things that you do. If I have a client who needs to understand, who is in this dilemma of how do I pull together, I'll involve you in the meeting. So because you can shed some lights on how the property part is going to work, I can shed light on the numbers. I can have the finance person join the meeting so we understand if your goals are achievable, if they're realistic, and how we're going to get you there.
Totally. So what I'm getting a sense is that, first of all, it comes down to belief.
Yes.
When we have experts in the room together, they can really look at, slice and dice every aspect of your refrigerator, the carrots that you have, the resources that you have, the recipe that you should have to get to your goal. And that will start with the belief system, the abundance that we really talked about as a mindset.
Yeah.
And then I made a point before, on a very casual way, that for the individual or the family, this is the business of investing. So that recipe or the strategy, by sounds of it, will give them the rule book or kind of a roadmap or the GPS. But now this is the strategy. It's like if you fail to plan, you're planning to fail.
Yeah.
But then you have the experts in the team that you don't really need to know the nitty-gritty of each and every element of it because it's such a specialized role. Even not all accountants are same. I mean, unless that they have specialty or the expertise in dealing with the property law or the property structuring, then only it makes sense for the family to have that person or the company as a stakeholder in their success. Is that a fair summary? Like thinking of this as a business, assemble the team who believe in your target themselves and work in harmony, rather than they talk individually and at a different level. They work in harmony to deliver the results.
Exactly, and that's why teams always succeed than a one-man show. We look at all these big companies who have achieved success, all these big groups who have achieved success. So the importance of team, it's already out there, it's proven. It's up to you how you're going to bring it together. If we don't have a team, sometimes I may have a client or you may have a client, and this is a very usual situation on a daily basis. The client will come to you discussing certain things. It's important to tell them, okay, we need to pull these two people together. Let's look at the numbers closely. Trust the team, trust the process. You will get there.
Oh, so true. So it's like what you're saying is that if I got a lower back issue, I need to just research the doctor rather than trying to work it out what he will do or what she will do. I just trust the person and then just go all in with the trust, because there's no point for me to half doubting all the time a doctor that I've chosen to work with.
Exactly.
Great point. Now, just for the starters, it seems very daunting. 4 or 5 professionals, we just count on fingers, and of course there's more, solicitor, property brand manager, and the likes, and getting the unknown. The key, I'm a big fan of going to the mentor, going to the coach, learning from them, because you don't really need to reinvent the wheel, or mistakes are very costly as well. So don't need to learn from own mistakes. So there's certainly a lot of benefit of going to someone who's doing professionally, but then there's always an element of cost, not just the belief. And if you put all this thing together, of course, it adds up. While we are paying as a buyer, we are putting across the deposit, then we are paying the stamp duty, then there's professional fees around it, and it just adds up very quickly, because we know properties are not any longer that affordable that they used to be. What's your recommendation to those starters to think about long term, think about the long picture and working backward, because that will really justify, in my opinion, the cause of doing this way. Because we talked about the statistics, most of the people do not go beyond 1 or 2 properties, 90% in fact, statistically. What's your take?
So look, yes, it is understandable that when you're going to engage 2-3 professionals together, there will be a cost involved. But the important thing for most of people need to understand is these costs are tax deductible. Okay. And this is the cost that you're spending to grow your portfolio. The cost will weigh out on a longer term. It's going to outweigh benefits by far. You need to think of a mistake at a lowest materiality level. When I say materiality, we use this as an accounting term. If your decisions vary by just 1%, which is not a huge number to look at, over a longer term period, if you bought a 5 properties worth 500,000 for 5 years, which was supposed to grow at 6%, but instead of 6, they're only growing at 5%, that mistake has costed you at least $500,000.
Wow. Power of compounding, huh?
Yes. And you're not buying properties to buy today and sell tomorrow. You're buying it. If you want to build a portfolio by the time you retire in 65, in your 40s, and as you said, properties have 10x in 40 years. In 20 years, it's still 5x, right? Averaging that. So you need to understand the importance of these costs. These costs are there to protect you from making costly mistakes. And when you look at the costs, they are not substantially breaking your bank. Yes, they are there. But you need to also look at these costs, that this cost might help me get to my goal much quicker. If you're not taking a right advice, you'll be stuck at 2 properties. I can guarantee you that. With the right team that you can trust, that's working closely with you, for you, yes, they're going to charge you for their professional services, but they're going to get you to your goal from 3rd, 4th, 5th property. I'm not saying come and use my service or come and use your services. Of course, we're going to charge for it, but we are the expert in the industry.
Sure.
If you're stuck in a situation, or you need clarity, because buying property is basically looking at a cloudy sky. Yes, the sun is out there, which you want to focus on and grab it, but you need the clouds to clear, and they're not going to clear. You need an expert to clear that.
Yeah, we call it lots of noise in the market, and still
it is noise.
Find the needle in the haystack.
Yes.
Awesome. Look, I'm enjoying this conversation, and this can go for on and on and on. I'll probably just ask maybe the last comment, the passing comments to someone who's dialing in, trying to understand, making some sense out of it. What will be your, say, 2 cents worth of advice to someone who's trying to look for building wealth in the long run? What would be your advice to them in a very short response?
Look, I work with a lot of new potential clients just on a simple phone call, which is free of charge to most people, that can clear a lot of clouds. You will be much closer to finding that needle in the haystack. So my personal advice is focus on your goal, remove the noise around you as much as you can. If you still feel that you're in a dilemma, they should come and speak to a person like yourself or myself or an expert that you may already have been engaged with. This will clear a lot of noise around your decision making. And don't stay confused in terms of how, when, where, what. You need to have a clear goal, and you should broaden your vision to just focus on that goal and get that happen.
That reminds me of a book, by the way, very well said. It reminds me of the book from Simon Sinek, Start With Your Why. Once you have clarity that way you want to go, then all the other aspects of what, when, how can be answered by the team around you. And the thing I will just also add, that phone call that we're referring to, because we are doing this in respective expertise domain, we also do happen to have the context of other professionals in the team, because
yes.
If somebody comes to you, you can obviously very well connect them to the other respective expert that they should be speaking to. So it's not one person, it's the access to the other people that comes along on the way.
Exactly.
Very well done, man. Thank you so much, Manpreet. It's a huge value. Certainly there were some questions around Superfund that I really want to ask, because that is really getting, lots of people are getting inquisitive on the back of not having enough mortgage borrowing power. And lots of people are going on the pathway of understanding, it's more, I guess, complex, if I can say that. It's more legal. So ask me questions, and if it is okay with you, as we have talked about, we would love to have you again in a month, over about a month's period of time for you to shed some lights around it. But meanwhile, if somebody has to connect with you, how would they find you? What's your approach? You talked about the phone call. How do we find you?
How do you find my number?
Your number, how do we, in a professional way, how do we go about connecting with you? The audience who might be keen to understand the nuances of what you just talked about, any member of your team or yourself, or just an email, whatever. What's your way of best contact?
We are very much reachable. The business is called AceBiz. You can go to our website, book a phone call with me, or call our office number. Someone will connect you through me, or send me an email. My email address is on my website. And then usually my response time is within 24 hours. So I will definitely get back to you and at least give you a clarity on, are we even heading into the right direction, or do you need a full face-to-face consultation with me? And 90% of the times, I would give you your answer over a 10-minute phone call.
Beautiful. But what I'll do, with your permission, I'll put some notes around this video for anyone who would like to connect with you. More than welcome. And thanks to you for offering that. So really appreciate it. So folks,
thanks to you, Rusty. Thanks for the opportunity. It was an amazing session. I guess my goal has always been about helping people understand property investing when it comes to taxes, because that is the biggest dilemma. Yes, property expert help them buy a property, but a lot of people don't make the decision because they're unsure about taxes and a lot of things and structures. And I'm happy to help anyone who is interested to get their questions answered on this space.
No, very well appreciated. It's so much appreciated, because it's about trusting, getting the trusted partners. And so folks, thank you so much for dialing in. Really, really appreciate it. As you can see, as we explored why investing in property is not a solo journey, but a team sport.
Yes.
The right partners, knowledge, and strategies to cross the finish line. As you could see, this was just not an interview, but more of a gateway to transforming your approach to property investing. So thank you so much for dialing in, and catch up with you next time. As I mentioned, there are details of Manpreet from AceBiz, who has given his time from his calendar to us to reach out to you. By all means, feel free to reach out to him. Any questions, he will only enjoy answering them. So thank you so much. Really, really appreciate it. Thank you.